Benjamin Reitzes, senior economist at BMO, joining us now. Ben, I loved your title, Taper Tony, talking about the announcement yesterday that, to be honest, was widely expected, by you and your peers.
Yeah, I mean, fully expected what he said, that the winding down of the programs has kind of already been underway. They already tapered the provincial bond program, and I don't think anyone was really expecting the programs to be extended once they did that. The initial market reaction was a little bit overdone. I think the headlines were maybe a little bit misleading, noting that programs were going to be halted. They weren't really going to be halted. They're going to be wound down as expected. Probably would have been a better headline. And as the day went on, the market reaction unwound fully and completely. And it looks as though that, I mean, as you mentioned, things are getting better. And as we continue to improve from a macro perspective, the bank will be taking their foot off the accelerator, as you mentioned.
Okay, so answer the question, why is Canada uniquely positioned to move first on paring back on this stimulus out of all the G7 countries?
So I guess that's a question for the Bank of Canada, how they want to manage that message. And so that's really what's going to be important, I think, in the April policy meeting. What's different in Canada versus other countries is the share of government debt that the Bank of Canada owns. And so he mentioned 35% in his speech. It's going to be really closer to 40% at this point. By the end of March, it'll be just below 40%. And if they were to continue at this current pace and we get a drop in issuance, which is expected in the coming budget. So we'll see on that front in a few weeks' time. But it is broadly expected we'll get a drop in issuance. And so if the bank keeps buying at the current pace, they're going to take a larger and larger and larger share of the government of Canada bond market. And that creates increasing distortions in the market. And that's not something they want. And so they can go one of two ways here. One, they can just signal really it's a technical move as much as anything else, similar to October. Yes, the backdrop is better, but they're still wanting to push as much stimulus as they can into the market. And the taper is more just driven by the drop in issuance. And maybe that means they increase their weighted average maturity of their purchases a little bit. On the flip side, maybe things are good enough to start pulling back a little bit. Is Canada uniquely positioned? Is our macro data any better than anybody else's? Not really, no. The U.S. is arguably ahead of us. So from that perspective, it wouldn't necessarily make a whole lot of sense for us to be leading the way on that front. But we do have a different target than the Fed. The Bank of Canada has a flexible 2% inflation target. The Fed has average inflation targeting, which the market interprets as being more dovish than what the bank's doing. So, I mean, there are some differences there, but I think it's going to come down to what message the Bank of Canada wants to send. And I guess we'll see in late April.
Well, let's talk about the other elephant in the room, which is housing. And Tony Gravel elaborated on that point. The most I've really heard any central banker talk about it recently in an interview with Reuters, saying, their data is showing there's increased flipping activity. It's taking up more and more of the conversations they're having with the federal government. What does that signal to you in terms of how important housing is becoming into factoring into some of these decisions?
Well, again, another issue the Bank of Canada is going to have to deal with, because interest rate policy doesn't only impact housing. But I mean, if you read the domestic media, pretty much every day there's a story on housing one way or another. Housing is on absolute fire almost across the country. It's not everywhere, but it is in most of the country at this point. And I mean, you can see price gains of 30, 40, 50% from a year ago. And especially hot are kind of outside of the cities as people look for more space, and work from home becomes something that it looks to be at least slightly more permanent, or seemingly so for now. And I mean, you're going to hear this continue as long as housing continues to be as strong as it is. And quite frankly, there's no reason to believe it's going to go in reverse anytime soon. It looks as though this conversation is only going to grow. And so this is an issue the bank will have to deal with, whether they deal with it with rates or with other policies, which probably make a little bit more sense at this point, given the economic hole the broader economy is still in, and the fact that the jobless rate is still very elevated, is a question. But it's something definitely they're going to have to deal with, and I expect something probably more on the regulatory side than on the rate side.
All right, Ben, you've given us a lot to think about. Thanks so much for your insight and analysis. That's Benjamin Reitzes joining us, senior economist at BMO.